bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, unlocking trade, tourism and investment opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs and small and medium enterprises (SMEs). The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home and invite you to go and see what is available for you to do. And you can see this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive perspectives of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions to be made guided by facts on the ground.
Today we started the Kenya DRC trade mission. We brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from the financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked, 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africas. Equity Bank is now like a medium, between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They're coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our 2 countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création de valeur.
organization to exist at such a time as this. We also want to thank you because you've made it possible for us to gather this morning for this investors briefing. How we bless this meeting and all that we are going to have in this meeting. We bless you for all those who are here, and also blessing you for our esteemed customers and our shareholders, thanking you for all our staff and all who play part in this great organization. We commit this meeting unto your able hands in the name of Jesus Christ, our Lord and Savior. Amen. Alex.
Thank you, Bishop. It's now my honor to invite Dr. James Mwangi to take us through the full year results investor briefing. Dr. Mwangi.
Thank you very much, Alex, and very good morning to all of you. We are glad that you've been able to join us for this morning's investor briefing. This is in respect to 2021 results, the performance of the year ended 31st December 2021. I want to thank you for the interest you have shown by being with us this morning. We can feed you and your expectations. We apologize for being 2 weeks of our usual reporting timeline for the results. But let's start off. This is the second year we are reporting our performance under the COVID-19 operating environment. And so when we looked at performance over the last 2 years, we felt it was not all about numbers. Numbers are very important to us, but we felt let's look at what truly it was. And for the first time, this bank and group has really been tested by an operating environment. We went out and made a public announcement of who we are and what we stand with and what we stand for, and that is through the equity group philosophies. And up front, we say our essence and our purpose is to transform lives, give dignity, and expand opportunities for wealth creation. We have never been tested on this commitment, on this proposition to community and society, to this pledge, and to this promise. And the test was whether for 2 years we could keep this promise to the community. Our blood was on trial. It's the blood that was being tried. Will we keep to the promise? Will we uphold the promise we had made under difficult situations? How will we behave? And we felt the community was really anxious to see whether we could abandon them or when times become difficult. But I'm glad, and I want to acknowledge the chairman of the group, Professor Macharia. Professor Macharia, maybe you could wait. And he convened a board meeting and said that the circumstances, what should we be doing under a COVID environment? Professor Macharia is a medical doctor, an ENT surgeon, a professor at the University of Nairobi, and a practicing doctor. And truly, after huge deliberations, it was resolved that the bank would continue with its social contract, the commitment as it has always done. And that COVID or no COVID, we were not going to deviate from the true north. The only addition the board added was that in addition to transforming lives, we should save lives because we were operating under a global health pandemic. And so we'll take a few minutes to really assess our performance under the circumstances, the mandate of saving lives, transforming lives, giving dignity, and expanding opportunity. So that is really what the scorecard was about. And that is what the objectives of the board was. And that could be achieved by championing the vision, and of course, executing. The governance structure remained and was strengthened so that we could be able to really focus on the qualitative aspect of the promise, and was strengthened, and we are proud of what we have been able to achieve because it protects. And we could see the interaction between strategy, execution, and skills, processes, systems, everything being put in place. So we strengthened the breadth and depth of the management team. I'm really glad that that management team helped us to push as far as we could. I look at this composition of my management, and Chairman, I feel very, very proud. If nothing else, we have affirmed our beliefs of giving equal opportunities. If you look, the team reports to me have women and have men, and broadly that speaks of what equity is all about. So equality in workplace, equal opportunities for all, and not discrimination for opportunity. Chairman, I thought I was performing well at management level, but when I looked at the board again, you are a team of 9, you have 4 men and 4 women, equal representation, representing the face of our community. And we're really glad that we have now completed that demonstration of that commitment, or leaving the commitment, both at the board level and the executive management. I want to applaud Mary, particularly for the program EQUIP. And as we celebrated the International Women's Day this year, we could sense the spirit of equality within the organization. But now let's focus on the COVID. I will not take a lot of time. We all understand COVID and the impact it has had. But looks like there is hope that the economic crisis is unwinding. We are aware the health pandemic is unwinding, but the social and humanitarian crisis is still with us. The economic agents have not really started generating opportunities, and consequently, the social and humanitarian challenges are there with us. You can see but there is hope that the situation will start reversing. In Africa, the reversal, next page, Alex, is slow. We see the reversal globally is because of vaccination, but in Africa, we still have a long way to go, so we should have more resilience to be able to do. But this is what the Equity Group did to respond to this situation. And if there is something I'm really proud, is seeing this group commit 5.8 billion shillings to complement government efforts in combating the COVID pandemic. We were very privileged to be given a chance to provide leadership to the nation. I am the chair of the COVID Health Committee of the Kenya COVID FAD Board. Our chairman, group chairman, is the chairman of the technical committee that of MEDICS that advises the board. And our own Dr. John is the secretary of that advisory committee. So 3 of us serving on the national committee then shows that we didn't only provide leadership to equity, but at the national level. Maybe that's the most variable support we rendered to the nation without pricing it. So that is not included in the 5.8 billion. The 5.8 billion is really cash. 2.9 billion of it was in terms of foregone revenue. We removed mobile channel charges to ensure that we incentivize people to stay at home and operate online. We wanted to make it possible. But when you look at the quantum of 2.9 billion shillings, is a very significant amount of income to the households, and that enhanced disposable income to the family. We had 1.7 billion shillings in terms of cash made at the disposal of the foundation to deal with the COVID. 1.1 billion was given to a commitment to provide PPEs to 116 hospitals, 66 mission hospitals, 47 county hospitals, and 7 national referral hospitals. I feel proud to say for 2 years we have kept the promise, and we still have PPEs to take these hospitals for the next 1 year. So our commitment of 3 years starts, and we are very, very proud that they have never had a moment of lack in terms of personal protective equipment for doctors, for nurses, for clinical officers in those 116 hospitals. The greatest commitment that the board wrestled with was the research done by a team led by Brent. Brent, maybe you could wave. We acknowledge the great leadership. That research team convinced the board COVID would be with us for 3 years, and that in whatever measures we were taking to support, we should have the stamina and resilience for 3 years. And as a result, our accommodation for customers who were adversely affected by COVID, whose businesses were on the sectors that were adversely affected by COVID containment measures prescribed by government, they needed to be accommodated. At first, we invited 45% of our customers and said, we are concerned about your prospects. Why don't you come? We support you, we accommodate you, we reschedule your own to ensure your business remain and strong, is not crippled by loan repayment. You're able to support your household, you're able to support your employees. 32% of all our customers stand up, and each of them was given an opportunity to articulate the support they could. We ended up rescheduling loans amounting to 32% of the entire loan book, and waived the restructuring fee of 1.2 billion. The shareholders made what one would call the greatest commitment for the stakeholders. For 2 years, they deferred taking dividends so that they could provide capital buffers for the risk of uncertainty, the unknown under our COVID environment. They wanted the bank to be able to support the customers. Rescheduling loans meant taking a higher risk, having a higher risk appetite, but the board stuck ground and negotiated with the shareholders, and we got dividend withdrawal for the first year, 2019, and 2020, no dividend was declared, amounting to about 20 billion shillings. That really strengthened the capital base, and we were confident. That was a very good signaling effect, and we were able to get $265 million in Tier 2 capital to ensure the capital buffers were adequate to accommodate us for 3 years. The risk management team partnered with global partners again to see whether we could support clients who had rescheduled, who in sectors that were really affected, and we built up $400 million of risk enhancement, partial guarantee, credit guarantees, and that has really enhanced our coverage to the extent of 128, over and above the 98% coverage through provisions. And of course, when you put the capital buffer, the credit risk sharing and all that, the liquidity buffers of the bank were all enhanced from 59 to 64%, giving us, covering the main risk in a bank, capital and liquidity and loan portfolio. So those three aspects. We have learned a lot of lessons from these, and if I just some of the lessons that we have really learned from this. One is the human resilience. Human beings are very, very resilient. 3 years down the road, we see the economy have started recovering. Innovation and creativity have allowed humanity to be able to develop a COVID-19 vaccine and give hope that we would be able to go back to our lives. We saw that equity's strength had been built on the shared prosperity model that we have championed, the social contract with the community, and equity brand, because of our investment in community, is rated at an all-high time of AAA+ in terms of ranking. And we also have discovered that doing good can go hand in hand with doing well. These two are not mutually exclusive, but you need a business model that delivers on that. The doing good should be embedded in the business model. But the biggest learning is that is best done when you separate and instinctively have two engines, an economic engine and a social engine, but ensure that they are running in sync. But the greatest of all lessons that we have learned is the power of a compelling purpose. The equity staff overcame the fear and certainty of a prospect of contacting COVID and paying the ultimate price through death. They overcame that fear and continue to champion the empowerment of our customers. We enhanced relationship management with our customers, and they sustained lending at an average rate of 27% growth rate year on year for the 2 years. Those lessons is what has really informed our thinking forward. And our thinking forward is that, yes, we have built the business on a strategy based on purpose. But there is an opportunity to build the next strategy, next page, on the vision of the bank, socio-economic transformation. And that explains why we have rolled out the African Recovery and Resilient Plan. We did it to our customers. We feel now we can do it to the entire community. And we have set aside $6 billion of seed capital supported by UN development banks to create a stimulus for the business community, targeting 5 million businesses and 25 million households, in the hope that as they scale, they start these businesses, they will be able to offer 50 million jobs to young people. So broadly, that strategy now becomes the business plan. Out of that strategy, we have developed the business plan. And the business plan projects, next slide, that we should be able to reach 100 million customers by taking a holistic national ecosystem to try and spur development, facilitate recovery and resilience of our economies. And in the process of doing that, then we shall anchor, when it comes to business, we shall anchor that strategy on 5 pillars. That is food and agriculture. We focus a lot on food and agriculture, manufacturing and logistics, trade and investment, micro, small and medium enterprises, and socio-economic transformation and environment for our investment. If we look at that, what we are then saying is that it is deliberate. The bulk of our population live in rural areas. They are living out of agriculture. So 30% of our credit will be allocated to food and agriculture. Manufacturing, to add value on agricultural produce, and then on extractives, we will allocate 15%. And to facilitate cross-border trade, will be the #1 trade finance bank in the region. And micro, small, and medium enterprises will get 65% of the loan book to ensure we formalize that sector, we link it with the formal sector, ensure it populates the value chains of the corporates, and that essentially we support local communities to build indigenous capital, if we may use that term, and at the same time get communities to fully participate in the economic opportunities. And hopefully we'll have 100 million people included in financial access. There were, of course, various interventions that will continue. The first one is the interventions to ensure nobody is left behind. We'll continue with our intervention on scholarship for gifted but needy kids. And I'm glad that the scholarships we had given over a period from 2009 to 2018, 17,000 scholarships. We gave a similar amount of scholarships in just 2 years. 10,000 scholarships in 2020 and 11,000 scholarships in 2021 to aid and to support during a pandemic crisis. And we are really glad today to say we have 22,000 kids in our secondary schools. We have 17,000 kids in our universities supporting to develop the next generation of leaders. These are not just scholarships, but because we are giving the best of the best, we hope will nurture the instincts of leadership in them and will shape the future leadership of this country. But the problem still rests with the young people. So we have launched the Young Africa Works, and this is a targeted project to ensure we empower young people to engage in entrepreneurship. We have trained 400,000 young people and provided them with the credit of about 139 billion shillings. And we are proud, in a period of 2 years, they have been able to generate 1.2 million jobs among young people. So this initiative will continue, focusing on farmers, supporting the farmers to adopt climate-smart agricultural practices, convert VPs and farmers into agro-businesses. And I'm glad to report we now have reached 2.3 million farmers. But an initiative, a young initiative we are proud of, is our concern about environment. And we have now, up to 2 years period, 432,000 households that have been given clean energy devices just to ensure we continue to support protection of environment, reduce the attack on trees, and ensure households are moving to clean energy devices. Together with the government and development partners, we have sustained during that period our huge intervention in social safety net. And we now have 3.54 million households that are receiving regular stipends at an interval of 2 months so that they could accommodate their lives. So broadly, that is what we have been able to do during the COVID, commemorate the challenges, the impact, and we feel that's the best scorecard we have ever had. If there is performance we are proud of, is remaining focused to our true north, learning the band and not deviating, not learning away from our purpose in the midst of uncertainty, remaining true to our calling of changing lives, giving dignity and expanding opportunities for our people. I applaud the credit division for ensuring, even in the times of uncertainty, when the IFRS 9 is challenging them to make provisions for the lifetime risk potential of the loan book, they accelerated and gave us a weighted 2-year growth rate of 27% of our loan book. That commitment, leading in uncertain period, interacting with the customers when there is risk of infection, and not caring, we felt that the power of our calling is greater than the fear of death. And I want to really salute them for this great commitment. So that is the best part of our performance. But as usual, investors look for numbers. But as I said, doing good is not exclusive of doing well. We have realized purpose is profitable. A purpose well executed on a good business model can be very profitable. So let's really look at some of the big things that we achieved. The first one is our regional expansion. And our regional expansion did better than we have ever done before. We now see our subsidiaries in the region carrying their weight. They are contributing to 40% of the balance sheet and the total revenue for the group. So essentially, we have diversified, and they have all become. If you look at cost of capital, the subsidiaries, where the cost of capital is approximately, for all of them, 21%, they are able to deliver 16.2. So they are coming of age, and we expect by next year they should be able to deliver returns above the cost of capital, and then at a much, much bigger scale. So that is a performance of our subsidiaries. But shareholders like this slide, what is the return on equity? What is the return on asset? And we are really glad that Uganda, at a return of 24, Rwanda, a return of 21, they are now far above their cost of capital. So we are simply struggling with Tanzania, South Sudan, and to a lesser extent DRC. But the journey the other two followed, together with Kenya, we trust is the trajectory we are seeing the new subsidiaries follow. And we can see Kenya took for almost 16 years to reach a return of 4%. We're now seeing Uganda delivering on that on 14 years. We are seeing Rwanda delivering on the 11th year, is able to achieve that. So we are very optimistic. The others will follow that route. And essentially, we now have become a high return, high volume business, or big size business with very, very high returns. When we look at the structure of the balance sheet, And maybe this is why we said we were heavily rewarded. The balance sheet expanded at a rate of 29%. We are lucky that most of the tier 1 banks have published their results. The average is about 6%. So we are growing faster than the industry by a multiple of 5. So if you have good returns and you are growing that fast, then you can see where the rewards of the customers would be. Where that growth, how can you have that growth and the returns are expanding? It's simply because of efficiency. And efficiency has come from our innovative agenda, which has focused on digitization. And we are now seeing that the bulk of the bank is purely on the digital platform. The legacy bank, as people would like to call it, processing 40 million transactions, 41 million transactions, while the digital bank is processing 1.25 billion transactions. You see the number of multiples of 40 million that you have in 1.25 billion. So the bank broadly has become an online bank. Online means the customers are self-serving. It's not even a variable cost model. The customer is the investor on the device. The customer doesn't require staff intervention. It's a self-service platform. And that, as we shall see, has helped us to do quite well in terms of cost-income ratio. What has impressed us most, it's not about the number of transactions. When it comes to volume, we can see the legacy bank is doing less than half of the volume being done online. So the customers are now, it's not the small transactions. This is not the case of telecoms. This is the entire bank being digitized, irrespective of the size of the transaction. So that's what really has helped us a lot. When we test what are the preferred channels, we have come to the conclusion it's mobile and internet banking. That is really where the future is. That's what we are investing in. And we are even seeing the merchant bank has moved away from the cards. The merchant banking has now become digital in terms of payment. So pay with equity, as we can see, is the fastest growing channel. From the previous year, 28 million transactions. This year, it did almost double, 54 million. So it's the fastest growing product we have, easing retail payments. And you can see now what it means. The cost of handling cash has been taken away from us. The single largest cost a bank bears is cash management, cash in transit, cashiers to facilitate deposits and withdrawals. That entire cost structure seems to be giving way. And we'll see later that despite the 29% growth, cost-income ratio has remained constant. We would expect that growth to come with a significant cost structure, income coming back later, but we see the bank has held. And myriad of products, and I want to really thank Lanere, as you heard with the team, for really developing these digital channels. We have given customers choice. There is no prescribed channel. The channel of your choice, adopt it. And we can see, as we said, if we look at EasyPay, transaction growing by 406%, and volume on those channels growing at 379. You look at EasyNet, which is internet banking, transactions growing by 376% and volume by 598%. This is a galloping adoption. And it costed us a lot. We gave 5.48 billion shillings to support all efforts to ease the pain of community. But we can see the reward of adoption by community. So COVID had one side a very depressing effect, but COVID acted as a tailwind for adoption of digital channels. We didn't have to do the effort that we could have done of training. People learned very quickly. It was the risk of contacting COVID. People wanted to work from home. So this is the biggest pressure we have of transformation. The transformation of the bank has happened faster than we ever planned. The adoption by the customers have been extremely fast because of the COVID protocols and COVID management recommendations. So essentially, we look at transactions are now 86% of all the transactions are online. 6% are on third-party infrastructure. And you can see what is happening to agency. People no longer want to convert digital money into cash. They want it to remain in cash. They are transacting it when it's still in cash. You can imagine branches are only managing just 1.5%. Our ATMs also 1.5%. So on our brick and mortar, only 3% of the transactions are happening. Everything else is happening outside the branch. Earlier on, it was third-party infrastructure, but now third-party infrastructure is only covering 10%. And we can see in terms of value, again, the value of transaction, massive transactions have moved online. It's no longer digital channels are not for the small transactions. It's the pace of change that also is very, very impressive. Year on year, you can see the rating proposition and how much it is changing. We can see how the payment capabilities are moving, the speed of adoption, the confidence people are having on online payments. So while the transactions are growing at 47%, we are seeing the volume of those transactions growing at 117%. And 75%, one slide back, 75% of our customers are now using cashless capabilities other than transacting in cash. The economy is increasingly becoming efficient. If you really want to know what is happening to the Kenyan economy, you just look at the trends in equity. We have 16.5 million customers. So we are a representative sample of the Kenyan society. So essentially, society has accepted to go digital. Is it happening because of the youthful population, because our mean age is 18? Is it that the society in its entirety? I'm convinced it's the society in its entirety. If it was the youth that adopted, we would only be seeing it at the transaction level. But we are now seeing it at the transaction level, at the value level. The value level is driven by middle income and high income. So essentially, it's a transformation of society. We now can see the future with almost certainty where we are headed to. And you can look at it, the pace of change is what is scary. In 2020, the customer base that was cashless in its day-to-day lifestyle was only 56%. A year later, it goes to 75%. So we will not be surprised that by the end of this year, 90% of the society will have moved to cashless. We thought that was a Western phenomenon. It has caught up with us much faster than we had anticipated. The question is, how ready is the business community? The society seems to be ahead of business in terms of, and we can see, if you look at the channels, look at the pace of growth. So it can take more than 5 years for the entire society to move cashless. So the readiness, and that's where Equity has been very lucky. Again, the IT team led by Lanre, they were ahead of their time, and payback period has been this. This is the enabler of the good performance that we shall be seeing shortly. And we can see it like in remittances. Look at the remittances, the growth in remittance volumes, 37%, simply because community has moved digital. And that, if you look at the Forex, 33% growth. So essentially we are now seeing it's whichever product you see, it's the entire society. Of course, a bank is known by the quality of its loan book, the asset book, and we may be looking very ambitious, saying we'll stand with the society, we'll expand the opportunities, we'll keep the rights of the economy on by pumping as much oxygen, as Polycarp tells us, to society during uncertain times. But you can see how well the risk is mitigated by the segments that we are looking at society. Look at how we have hedged against risk like exchange rate. 43% of the loan book is in foreign currency and foreign currency, when only 56% is in local currency. So essentially, exchange rate is now inbuilt muted. We reached out to the customers, but it appears our society can never be anybody's debtor. So we went to accommodate them, we did everything we could, but look at what has happened to our loan book. We entered COVID with an NPL of above 11%. Actually, first quarter, when COVID struck, we were at 12.7. 2 years into COVID, our NPLs have come down to 8.3. Society has been very kind to us. And as a result, we have not taken it for granted. We have decided to ensure we increase coverage. As you can see, our coverage on provision basis has come all the way to 98%. IFRS 9 has been applied to its fullness. Any expected lifetime loss has been provided for. So we are not carrying any burden to the future. But our conservatism on the sectors that were adversely affected allowed us to hold provisions far above 100% at 198. So beyond 98, all the way to 128, that 30% coverage is by global AAA rated development bank guarantees. This is for specific sectors that we had uncertainty, that we had extended moratoriums for 3 years. We have almost comprehensive and full coverage. So what are we saying? We are going into the future with confidence that there is unlikely to be any surprises because we have been very conservative. And we can see that when you look at it, the coverage, as we said, of 128% of the entire loan book. And that has really given us confidence. And we have given very detailed analysis to help people reconcile those positions, which sector is performing well, and what is the real movement. We have matched the movement of the 3 years, as we said, and what is the performance of each bucket, and what is the size of each bucket, again, to bring certainty to the investors that we are not carrying into the future past risk. And then we can see what has happened to the interest, net interest margin, expanded a little bit during the period. We are recovering the shock we went to. And This is a trend we can anticipate to continue happening. Equity grew at 29%. We couldn't be able to match the growth on the liability side because it's a 29% growth in deposits that has induced that growth. There is always a timeline of investing. So all that growth has been invested in short-term government securities, which grew by 81%, return grew by 81%. But as that treasury bill stock is being relocated or reallocated to credit, we'll see the yields on interest-earning assets bounce back maybe to about 10.5%, 11% in the short term as we reallocate assets to high-earning assets. And of course, the impact that the bank continues to have in society, we have talked a lot about this in the introduction, when we are checking the investment. Our interventions in society have now reached nearly 60 billion shillings for various projects. As you can see, we have planted 12 million trees. The most significant thing is not the 12 million trees. It's that these 12 million trees, we have subcontracted the youth to provide us with the seedlings. So we are buying from nurseries owned by young people. So essentially we have created thousands of jobs. Eric Naivasha, where are you? Our team leader, Eric, has led us, and we are very, very proud. If there is anybody who has given more jobs to the young people in what they are best at, it's Eric. So that 12 million trees, and we still have another 23 million trees to plant in the next 2 seasons. So that is only scaling up as we move on. So let's look at now, these are numbers. But what does the community and society remain? Equity has, despite COVID-19, we have retained our global credit rating at the sovereign level. We have improved our performance among the top 1,000 banks, and we're proud of the rating. And this, you could be able to look at it. And it's not just 1 or 2 awards. I think we can go through. Locally, we continue to be the best bank in each of the sub-brands, whether it's retail banking, whether it's corporate banking, all segments. But this is the most interesting award we have ever won. We are ranked the 5th best brand, banking brand or finance brand on earth, with a AAA rating. And in terms of valuation, we are ranked the 338 most expensive. We have been able to monetize the brand and the brand value. And those who look, we trade nearly 40% premium above the Nairobi Stock Exchange, simply because of the brand. And beyond the brand that's coming, we are really proud that Bloomberg has picked us among the top 50. We've won the Oslo Business for Peace Award, and Polycarp led us to go to DLC. Despite COVID, he made us go to DLC on a trade mission. I'm glad to report we now have 26 traders who have returned with a deal pipe of $1.6 million of investments opportunities. So we are processing them, and that again helps to promote cross-border trade at the East African level. Let's now look at the balance sheet and see what the P&L. We can start with the P&L, Alex. If we look at the P&L of equity and what it portends, interest income has expanded by 25%. to correspond with the 27% loan growth. It's a 1-for-1 growth. You increase the loan book, you are not increasing provision because the quality of the loan book is improving significantly, so it becomes a direct transfer to the P&L. Non-funded income, 15%, and so total income has expanded or grown by 21%. As we said, we didn't need to increase provisions. The loan book has significantly improved from 11% to 8% NPL ratios. So despite supporting our staff with a 24% increase in staff cost to ensure they can manage the COVID environment, and our other operating expenses is growing by 19%, our total cost declined by 16%. And that then gives us a profit before tax, a growth of 134%, with profit growing from 22.2 million to 51.9%. After tax has grown significantly by 470. We are glad we are able to support our government with that tax revenue to serve communities. But to the shareholders and other stakeholders, net profit has grown from 20.1 billion to 40.1 billion, a growth of 99%, prompting earnings per share to grow by 98% from 5.2 shillings to 10.4 million. To 10.4. And with that good performance, the board has recommended a 50% increase in dividend payout from the previous payout in 2018, which was 2 shillings, up to 3 shillings, increasing the dividend payout to 11.3 billion shillings, the highest dividend that the organization has ever paid. So we see the P&L very well alleged, but this P&L, we can almost predict how it will be next year if we look at the balance sheet. The balance sheet suggests that the growth of 29% is all packed in government securities, which have expanded from 200 billion to 400 billion. 200 billion has been packed in government securities, growing at 81%. We believe that that is a temporary housing because the commitment of the bank is to support our customers to expand opportunities for wealth creation. That money will find itself in the loan book. And that money has come at a time that we have now managed to find a formula of pricing risk, so that money easily, we can now accommodate all borrowers because each borrower is rented at a rate that take into account their risk profile. So we expect significant growth at the loan book. We are glad we have introduced our customers to the opportunities in the region. We believe like the deal pipe of 1.6 or almost 170 billion to DRC will require funding, and funding is available. So the growth of the bank is driven by the customers, as we can see. It's the customer deposit that determines. The entire 29% growth has a corresponding growth in customer deposit, 29%. Look at the confidence of the international community to back equity, just in case there is need with Tier 2 capital and with credit lines, 32% growth. So its customers and lenders have driven the balance sheet. And the lack of dividend payout for 2 years have also got the shareholders to increase their shareholding, or the shareholders' funds, by another 27%. So essentially, we see the three arms. lenders, customers, and shareholders, all on the liability side, increasing their contribution or their funding by an average of 29%. So it's a very balanced model. When you look at funding mix, because that is funding mix, very, very long term or permanent, 27%. Long term, 32%. Medium term and short term, 29%. That gives us a very, very well-blended funding mix. And this bank is very, very lucky to have such a mix so that irrespective of whether the customer wants long term, medium term, short term, the funding mix of the bank, this bank has no opportunity of a mismatch. And so we can lead the entire balance sheet without risk of mismatch because of the blended nature. And I'm really glad our strategy team has managed to get that light. So what we see, because we can always talk about this balance sheet a little bit. As the balance sheet grows, there is a huge opportunity of reallocating from government securities, which are low yielding, to high yielding credit risk based lending, credit risk pricing based lending. That's a huge opportunity. The second opportunity is that the cost of that growth is declining because the customers have adopted online and moved away from brick and mortar, which is a fixed cost. They have moved away from that third-party infrastructure of agents and merchants banking, which had a variable cost, and they have moved to a self-service model, suggesting that the operating cost of the bank will continue to decline. So revenue going up, cost going down. I hear economists like James Motuko, our treasurer, saying the jaws are widening. So what I hear the language. So I think that speaks to analysts and the investors. That's what we see going forward, that here is a huge opportunity. I'm taking a little bit of time here because investors need to be aware. I have no opportunity of doing, maybe you call it what? Notice. What do you, when there is an event that's likely to have significant, sorry, Mary. I'm asking, what do you call that statutory notice that you give to the public? Cautionary statement. I have no opportunity to give you a cautionary statement that the jaws are widening. But beware, be cautioned when you are trading with shares of equity, that the future looks much brighter than the past. The good thing also is the risk of the inherent risk current in the balance sheet has completely been provided. I'm not saying there will be no risk into the future, but we are not carrying forward any credit risk. That's why we have 128% provision on identified risk, which has been well computed and IFRS 9. So that's the big takeaway from me looking forward. We have seen our capital ratios. If we go to the ratios start, we can, very good. So let's look at Kenya, return on equity. Look at it where it is and where it has moved from and how it has pulled the group. And return on assets. If we go to the next slide, because that's the most important thing, you have no challenge of liquidity. You have no challenge of quality of your loan book. So you can operate very efficiently on a capital basis. You can operate at minimal buffers. Why? Because liquidity buffer is very high. Asset quality buffer is very high. So the shareholders don't need to take the burden of having very high buffers. What then does it mean? It means with the potential of yield on earning assets likely to go up, the jaws opening up, the bank can continue to expand with the current capital ratios. The capital ratios at 13 on core capital to risk-weighted assets and 17.7, 18. As you can see, the capital ratios are almost at the same level with the banking industry. It's almost at the same level with banking industry, but of a very unique bank with very high liquidity ratios and with very high quality asset portfolio. So essentially we see, in summary, I summarize what, but just before I summarize, a month ago or so, we launched the strategy of the bank, the Africa Recovery and Resilience Plan, that is ambitious in giving $6 billion. We all have seen where the $6 billion is. It's in cash. It's both long-term, medium-term, and short-term. So we're able to match the expectation. That will be reallocation on the balance sheet. Huge opportunity. It is predicated on cross-border trade, and we have tested, and we can see the volume. In just 2 months after the visit in DRC, you generate a pipe deal of $1.6 billion. That gives you a feel that cross-border trade will become huge. That's a huge opportunity for trade finance. Where is Kennedy? Kennedy shocked us. He grew trade finance revenue by 55% last year. Now, with this huge reading opportunity, cross-border, dollar-based loans, we can see the greatest opportunity in terms of growth. So that is where we are seeing Anthony derivatives. We have seen derivatives now kick in. Why? Because of commodity prices. Commodity prices are at a very high level. The mining community want to protect those prices. We have been shocked by the level of interest in derivatives, and that is a very huge opportunity. What all these I'm talking about are non-funded income opportunities. So we are likely to see the quality of earnings continue to improve as we shift more and more. John Mukono, are you in the room? The fastest growing line, again, is e-commerce transaction. If you look at our e-commerce transaction, despite not drawing income from mobile transactions, we have seen a very significant jump in our incomes, all because of our channels and because of e-commerce. So that opportunity of customers migrating on self-service platform really increases our opportunity to grow the bank. So when we look at the future, we are confident that the new strategy will bounce us back to our familiar grounds. And our familiar grounds is where our performance tended to grow tenfold every 5 years. If Alex, we can have that slide, we can see one unique phenomenon. Performance trend analysis, Alex, tenfold every 5 years. So what we are seeing is a good opportunity there of the bank bouncing back on the rails of the investments that we are putting through, that for 20 years, for 25 years, this bank, without missing, was able to sustain a 10-fold growth of all parameters every 5 years. Then it dropped because of interest capping. We dropped that to twofold growth for the period 2011 to 2016. We can see that became twofold. But look at what happened from 2016 to 2021. We have accelerated, and the balance sheet, the funding, the loan book, the asset book, the shareholders' funds have tripled. The bank is now on an accelerator level. And we see all the parameters. That is the future we are seeing, the bank being able to accelerate on account of 4 things: digitized processes and procedures, very solid, strong policies, high-skilled human capital, and very robust systems. And the last one is a top-of-mind brand, a global brand with a regional risk, balancing the sovereign risk. Let me summarize all the things I've said. That the balance sheet of Equity Group have grown by 29%, moving from 1 trillion shillings to 1.3 trillion shillings in a span of a year. 300 billion shillings balance sheet growth. Loan book to the customer deposits have increased from 740 billion to 959 billion, a growth of 29%. The expansion of deposit, driving the growth of the balance sheet, has made Equity emerge the largest bank in Kenya and the largest bank in the region in all respects: balance sheet, profitability, market capitalization, and customer base. Equity has seen improvement in its on loan NPLs, non-performing loan book, from 11% to 8.3%, with an increase of coverage, provision coverage, from 89% to 98%. Equity has seen a 99% growth in profit after tax, from 40.1 billion to 40.1 billion, up from 20.1 billion. A 98% growth in earnings per share to 10.4 shillings per share, up from 5.2 shillings. And the board has recommended a record dividend payout of 11.3 billion shillings, a 50% increase from the last dividend payout for 2018. And lastly, Equity Group is well positioned for the future. And Equity has chosen to remain focused to its true north, irrespective of circumstances and operating environment. The policy breaks the decision or not the environment. With those many words, I want to thank you most sincerely for listening to me, but I want to invite my colleagues for a couple of interventions. I want to talk little. I didn't quantify risk, but maybe Sam, broadly, you can make a statement or two on the risk position of the group.
Thank you, James. So 2021 was challenging, as James has indicated, COVID being the predominant challenge, but spawning various other challenges. We had to deal with customers whose businesses were greatly affected and had to extend support to them. James has mentioned the digitization, the shift of our customers to digital channels, and therefore the need to support these customers through building out these digital channels while ensuring we keep them secure so their transactions are secure, free of fraud and cyber attacks. We had to keep our staff safe, and James has spoken to the initiatives internally but also externally to keep both our customers safe from the pandemic. Massive operational risk with thousands of our staff working from home and also supporting customers who are working from home. We had to continue onboarding our customers, KYC, and performing transaction monitoring, watch list monitoring, sanction screening as required by the regulators. We had new guidelines from the regulators to deal with, such as climate risk guideline and others. So it's a year in which industry players faced challenges from various perspectives. The macroeconomic environment, local and global, very difficult. So the results presented today demonstrate huge resilience within the business and also a significant appreciation for the support we received from our customers during 2021. And we used the opportunity to strengthen the risk function within the group to position ourselves to be able to cope with these challenges that we expect to continue going forward. So bringing in more senior leadership into the group risk function in various areas, IT and cybersecurity risk to ensure our systems remain stable, our platforms remain stable, working alongside the first line led by Landry, operational risk, financial crime risk, compliance risk, ESG and climate risk, and so on and so forth. We are revamping our policies and processes. We are investing in systems to be able to provide a solid foundation for risk management within the group. And all of this is happening as the group continues to grow and increase the customer base and support its customers. We thank our customers for being with us, continuing the journey for us, and we assure our customers of our continued resolve to support them, to enable them transact safely and securely with us. Thank you, James.
Thank you very much. So it's really good to hear a global expert in enterprise risk. We are very, very lucky to have some who have a lot of experience from European banking, Middle East banking, South African banking, always in charge of enterprise risks of global banks, giving us certification. But the best certification was the performance of equity over the last 2 years. Our model have been validated as very resilient and very responsive. Unique performance built on resilience and responsiveness of a business model. And hence, we can only accelerate it. But maybe let me ask Ranre, maybe just to make a short statement on the state of policies, procedures, processes, and maybe systems and the robustness to support the group. As we see, it accelerates in growth and support the entire 6 countries to recover and develop resilience. And we feel we have the moral authority because we have demonstrated resilience to show the path, to provide leadership, and to maybe accelerate growth? Lanre.
Thank you very much, Dr. James. So what we did during COVID was, while some organizations weren't sure what they needed to do, we were sure, we were certain that we needed to help our customers. We stabilized our systems, and at this same period when it was even difficult for organizations to ascertain where they wanted to be, we kept to our strategy. We recruited about 16 CIOs from different countries of the world. And then we also decided to fortify our processes and procedures. Not internally, we got our internal auditor to do that. We also got certification from world bodies like Business Standard Institution. We got our ISO 27001 during COVID, and also ISO 20000 during COVID. These are things that even physically could be very difficult and challenging to do, but we're able to do all those things even sometimes online. And we did a lot of investment around data. Before the whole COVID period, early 2021, we had just about 2 or 3 people in our data science team. Now they are about 26 and growing, with world-class data scientists across the world joining us so that we can make decisions, not just preemptively, but also using data to make those decisions. Some of the things that we also did is, this is the first time you have an organization this big that has a board that deals just with innovation and technology, and this board has been very helpful, headed by Professor Timothy of Nairobi University. We meet with them on a regular basis to understand what is happening, and we also set up a lot of ops and innovation ops, and do a lot of collaboration with universities across Kenya. And also in terms of security, we fortify our security. We got a CISO from South Africa to join us, to join our developing security team, so that we can ensure that we have a very strong and fortified security to protect the asset of our customers. And of course, we have a great support from the entire management and of course the GC of Equity Bank. Thank you.
Thank you, Lanre, very much. Maybe I would ask the CIOs who are present in the room, over COVID, from 1 CIO to 16 CIO, if they can be studying. That's honor you are, that's part of the team of CIOs, from 1 to 16. That shows you the commitment we have put to ensure we get it right. The customer have demonstrated to us there is no going back. They want to live in a cashless world. The bank has changed to a technology company from a brick and mortar environment. So you can see the management now is heavily technology. I thought you are part of the CIOs who implement. Alane is one of your team members who is defecting. But you can defect to my office. Abo is our project, IT project leader. Thank you very much. You may be seated. Very good, Lanre, for the assurance, the certification, that it's not what we think about, it's what certification tells us of the standards that we have put our system. Polycarp, Polycarp led us into what we called customer, he told us customer relationship management, hunting like as a pack, market storms, trade emissions. We give a lot of customer growth to Polycarp's interventions. This is the only man who never operated from the office or from home for 2 years. Polycarp, you may want to, thank you.
Thank you very much, James, and good morning, everyone. The founders of our business defined our vision as being champions of socio-economic prosperity of the people of Africa. And today's set of results truly speaks to a milestone achievement of our journey towards that championship of socio-economic prosperity for the people of Africa. In what ways? You see in our revenue growth at 21% growth relative to an economic operating environment at 6%. You're basically galloping ahead of GDP growth because you've demonstrated the depth of affinity of the brand in the market, which is born of the social impact of the business, which James spoke to, in terms of what the foundation has done, what we have done with health, through Equity Afia, what we have done with education, through Wings to Fly and the scholarship program, what we are doing with energy and environment, what we are doing with financial inclusion. Then secondly, is the commercial impact that has created jobs, truly driven by the Young Africa Works program, where we have disbursed loans to over 430,000 small medium enterprises, and also enabled very strongly by an ICT, an information communication technology platform that has really worked. So it is the story of relevance. So relevance, in addition to a resilient business model, a responsive business model, as James put it, it's also become a very relevant business model to our market and our customers, and we thank them. Lastly, I think it's also been the accessibility of our channels, our branches. The real heroes of the results you see today is our business growth and development managers across the group, wherever they sit. We continue to grow branches and the level of our field representation. We continue to bring to the market acceptable products. We are the bank that makes solutions for customers by visiting them, not by having a product rack that we present to the market, but working out solutions with the market. So accessible channels, an accessible team, acceptable products, and very affordable offering where customers are really choosing the value that we offer them. So it's been a result that speaks to the socioeconomic prosperity and the shared socioeconomic prosperity of the people of Africa. And in closing, when you look at the performance, especially of our loan book, we are very lucky, because we can only say we are lucky, that we are attracting customers of the right character and the right ability to pay. It seems there's an aggregation into equity because of the relevance. Because when you look at the COVID-19 book, the moratoriums we gave, and over 70% repayment of that coming through. So we are a bank that attracts the best. We are a community of members that attracts the best, because repayments of loan is a function of the character of the customer and the ability of the customer to pay. And we give thanks, and we want to continue asserting that we shall continue to earn the right to our customers' hearts, pockets, and lives through championing this vision, which is at the heart of the strategy we're executing. Thank you, James.
But just before you switch off your mic, I'm sure people can benefit a lot if you said that couple of words about the brand. There is nobody who is better positioned to talk about the equity brand than you.
Thank you very much, James. I think when we have a brand that is truly driven by adoration. The equity brand's adoration, brand profiling has graduation. There are brands that are driven by a set of people you call available people, acceptable, a universe of acceptability, a universe of adopters. But the equity brand has a very high level of adoration, especially with micro, small, medium enterprises and individuals and households. People who truly believe and buy in to the vision and the purpose. And the brand is really grounded on a philosophy of do good consistently and then do well sustainably. We don't ask that of ourselves. We ask that in the relationships that we build with customers. And as a consequence, with that level of adoration is then reflected in the numbers. The story must be matched by the numbers, because when you go to the numbers and look at the quality and quantum of lending we have done, the quality and the quantum of transactions that have aggregated through our channels, it speaks to the relationship. Adoration is a function of relationship. And so in equity, all our branch managers, the front office, the middle office, we have transformed ourselves not from bankers who look at transactions, but really relationship people. People who have a true relationship with our customers. When they're in pain, we stand with them. When they are not in pain, we continue to stand with them. And our loan book expansion at 23% in a COVID period speaks to the fact that truly we are a brand that is giving the umbrella whether the sun is shining or whether it's raining. And that commitment, I think, comes, that leadership comes from there. And then lastly is you see the brand relevance comes through the work we did with personal protective equipment in education, what we are doing with educating and preparing people to become credit ready, so not reckless lending, but really preparing our customers in training them, making them understand the difference between cash and profit, why you must have a personal bank account that is separate from the business bank account, or how you can negotiate yourself to collect your cash very early from the market and pay your suppliers very late, why you need your return on capital to be bigger than the risk-free lending rate in the market. So really educating customers on that. And beyond that, therefore, the brand equity historically was seen as a brand very relevant to consumers and micro, small, medium enterprises. And we celebrate that in this result, there's been a trooping of corporates and large enterprises who have finally come to drink out of the pool of MSMEs and households that are with us. There is not a single large corporate enterprise that is not now having a relationship with equity. And they have not just come for transactional purposes, they've come for the deep relationship purposes, and that's why we speak about ecosystem. We do not see a difference between, we see a real interconnectedness between micro, small, large enterprise, corporates, and the government and the public sector banking. Thank you, James.
Thank you very much, Polycarp. Allow me to lead a single out a special team. If you looked at our NPLs, it has not only declined from 11% to 8%, but the absolute number has declined from 50.6 billion to 44.5 billion. That initiative is because we put a special task force in my office, which collected 8 billion shillings from the non-performing loan book and really prevented and protected spillage. And that team is made of Clement and your team, and Christine. And very good. That team, you started, I didn't want to talk about you when you were studying. That team of 3 have taught us a lot. That the world is not changed by the multitude, but a very convinced team, passionate about what they did. During COVID, they collected 8 billion shillings from NPLs. Absolute NPLs declining by 6 billion shillings. People have been wondering, Christine, where you left from. We had to reallocate Christine from being company secretary to leading the legal team that support the credit collection team of Clement and really Mike. We really owe you a depth of gratitude. Continue. Can I say the commitment you have given me? And they have given me a commitment that this year they will decline NPLs from 44 billion to 30 billion. Now it's a public promise. It's not all got to me alone. The shareholders have heard, and they can factor that absolute NPL number will be less than 30 billion shillings. So essentially what they are saying, James, you don't need to provide even for 2022. I'm grateful. Thank you very much. Brent, just speak on 2 things. What are the biggest drivers of performance that were not a one-off, that has really become part of the equity business model? And hence, this superior performance, you can assure our investors that it's not a one-off. It's a new way of life, and that is why we are saying we are bouncing back. And lastly, the second item, what will be the impact of the Marshall Plan, the recovery, resilient, and growth plan for East and Central Africa that we are seeding with the 6 billion, and has caused us to partner with UN, 16 development banks, the 6 countries themselves, foundations around the world to ensure industrialization of East and Central Africa.
Great. Thank you, James, and good day, everyone. So on the first question on essentially the recurring nature and the quality of what we reported today, where we reported significant growth across a number of financial metrics. So I think the important thing to highlight is intention. There was a lot of intention in what we did going into COVID, if you look at the management actions. So we discussed in detail over past investor briefings the defensive strategies that we had put in place. James talked about the support, and Polycarp as well talked about the support we provided customers with the loan accommodations, the waiver of the fees, how we treated staff, how we supported communities. So we were very intentional and decisive in going into the COVID environment. And you can see this intent has come out with a lot of momentum in the business. And momentum can be reflected in the revenue. We appreciate that the lower provisions has no doubt supported what we did, but that lower provision was always there given the decisions we made back in 2020. You'll recall we proactively managed and ensured buffers were in place back in 2020 when we had a cost of risk above 6% as a group, and in Kenya almost 7-8%. We also were very intentional right at the onset of COVID on what the impact could have on the economy and our customers. And you'll recall, whilst we have only accommodated 32% at its peak in terms of supporting customers, we did highlight right at the outset and before any other of our peers communicated that we would support up to 45%. I think, and we're seeing the fruits of those decisions, those proactive and decisive decisions. And Polycarp has seen this in interactions with customers on that proactive support that we gave customers right at the onset when the impact of COVID was somewhat still being understood. We stood right beside our customers. So there's a lot of intention in what management is doing, and it's leading to momentum in the business. As I mentioned, momentum is reflected in the 21% revenue growth. All of that is recurring in nature. And there is also supporting that momentum is the capacity that the business has reflected in the balance sheet, and you can see from the staffing that we have, including in IT. So on the balance sheet, we have a loan to asset ratio of 45%. It highlights we have a lot of capacity, as reflected in James Matuku's business, of redirecting that unutilized capacity to the private sector. And I'll talk more about James's second question around the Africa Recovery and Resilience Plan. What is also reflected in our numbers is the quality of the revenue streams. We have a high proportion of non-funded income. We appreciate that going into an environment where you have global uncertainty with what's happening in Ukraine and Russia, we have a composition of revenue that is high quality in the sense that it is low capital intensive. It comprises of transactional businesses, including payments, what we're doing on FX. These are revenue lines that will continue to grow in a smooth manner, irrespective of where the business cycle is. There's also the capacity on what we've been doing over the last few years in terms of increasing the skill sets, enhancing the skill sets that we have, expanding the product capabilities. James talked about what we're doing with derivatives, what we've done with trade finance. So the basket of tools that Polycarp and his team has expanded as well as deepened if you look at what James Mutuku has done in terms of moving from spot markets to derivative markets. And it's also reflective of how the economy is progressing as well and developing. It is not by chance that we decided to go into derivatives. There is a level of development that is taking place. And for the foreign investors, if you just come to Nairobi and you see the level of infrastructure taking place, Nairobi, Kenya is indeed becoming the gateway into East and Central Africa, and is indeed with what is reflected, and as James highlighted, we have 16.5 million customers. It reflects truly what is taking place in the economy. And the diversified nature of the loan book reflects diversification taking place in the economy. So Kenya is really well positioned to be that diversified manufacturing hub that provides a gateway into East and Central Africa. And you'll be aware that DRC will soon become, in fact, next week, will become a member of the East African community. Again, on intention, you saw us enter the market in DRC back in 2015. We continued to allocate capital into the DRC during a COVID period. And you saw us during the COVID period supported customers by taking 300 Kenyan businesses to the DRC in December, which has resulted in potential future pipeline of $1.6 billion worth of business for the group on one trade mission. And that's just pretty much 2.5 months since we hosted that trade mission. So there's a lot of intention in what we're doing that is driving this recurring nature of the earnings, the revenue. So these were management actions, these were intentions 2 years ago going into the COVID period. We remain intentional in what we're doing. And this intention is reflected, and if I go to James's second question around this Africa Recovery Resilience Plan, the objective of the plan is essentially to industrialize Africa. It's to accelerate the African economies to move to middle income status. And the intention there is to do it leveraging off what has always been there in terms of a business model, and James highlighted the social engine and the economic engine. And the various teams that have stood, Polycarp has commented on the brand. It's essentially what we're doing with this Marshall Plan for Africa, this Africa Recovery Resilience Plan, is taking this business model and really scaling it up at a regional level. It's underpinned by 5 strategic pillars, which are essentially looking at connecting, better coordinating, value adding within the value chains across Africa, starting with the markets that we operate in. So the 5 strategic pillars is around the primary sectors. So it's agriculture and it's the extractive sectors. These are essentially the raw materials which Africa and in our markets as well are well endowed, whether it's the agricultural potential, whether it's the commodity potential, as we can see with DRC, we can see with Uganda, we can see with Tanzania, even Kenya. The second strategic pillar is around value adding those raw materials. We don't want businesses in Africa to just export primary goods. We don't want Kenyan businesses to continue just exporting the primary horticulture produce. We want a lot more value addition, even if it's just one additional step of processing or value adding, including in the DRC with cobalt, for instance. The third strategic pillar is around providing markets to those two first pillars. We want to increase market access to agricultural value chains, whether it's in Europe, UK, North America, in the Far East. We want to increase markets, and even within our own region, and explains the trade mission we had in DRC. That sits under one of the initiatives we had, or we have, under the trade and investment pillar. The fourth, and the first three is really one continuous value chain, and it speaks to our comments and what Polycarp is doing with this ecosystem financing. It's to provide a holistic solution to value chains. The fourth strategic pillar is around the micro, small, medium-sized enterprises, and that is really our initiative to really connect the informal sector into formal value chains, into off-takers of their products. The fifth strategic pillar, and the last, is around capacity building and supporting communities in which this whole value chain operates in. You've seen statistics, you've seen our disclosures around the number of micro, small, medium enterprises that we have supported in terms of financial literacy, entrepreneurship training, the number of kids that we've sent to school, the social protection initiatives that we have, the health clinics that we have. This is really taking those four pillars, building capacity in them. So for instance, micro, small, medium-sized enterprises, or the team in agriculture led by Esther and George, that builds capacity in smallholder farmers so that their production improves in terms of yield, so that they're better equipped to manage a business, and they're better ultimately to be connected into formal value chains. You piece this together, we believe we can industrialize Africa in a much shorter period of time, but it no doubt requires a lot of collaboration. So we are partnering and collaborating with various and different stakeholders globally as well as locally. We appreciate to industrialize, it will require a lot of capital. It requires us to change the narrative of the continent. And if we speak to what we're doing in the DRC, the trade missions that we are doing not only increases trade within the region. At the moment, we're actually hosting around over 100 Belgian companies in the DRC. It's not only about increasing trade, but with trade comes better appreciation of opportunities and the way Africa operates, and therefore it attracts foreign direct investment, permanent capital over time as well. And that will help and fund industrialization of Africa. Also, the value addition that we want to take place ensures that wealth is retained on the continent, so that value addition, where the higher margin business is not exported. Ultimately, by exporting primary goods, you're exporting the higher margin, the higher value part of the process offshore. A lot of that, and the productive capacities of Kenya, if you look at Mombasa, Nairobi, Kisumu, Nakuru, if you look at those manufacturing hubs, Kenya is well positioned to do value addition. It has a diversified capacity to do light manufacturing, heavy industry, car assembly. So there is intention in what we're doing, and that intention is really being focused, and this business model is really being focused to the second question James has or had on this Africa Recovery and Resilience Plan. So we believe there is a recurring nature in what we are reporting, and we believe there is a lot of momentum given how we plan to execute this. So.
Oh, thank you very much, Brent. If we compare notes, what I heard Brent say is that equity has distinguished itself as having a very unique management and leadership team. Maybe people have never fully appreciated the value of when he's talked about intentional, deliberate. Those are management and executive decisions. So it's a very unique board, a very unique management that has distinguished itself uniquely and said, it's in a class of its own. The second thing is the capacity of the bank. It's not just about management, it's the entire staff of Equity Bank. It's the robustness of its systems, processes, and policies. So it looks like everything that needs to be in place is in place. The second one, Africa has always yearned to industrialize. The question has been how. And unfortunately, because of we are made of 54 countries, looks like nobody has ever championed that cause. We have been shocked by how much support we have got from globally. Everybody saying we have been waiting for this, nobody has ever provided leadership. Equity has demonstrated it can align the interest of every African nation to prosperity and bring, using its blood and gravitas, the international community. So it's not just Kenyan going through DRC, Belgians going to bring capital to DRC, process in DRC. We have been humbled. The United Resident Coordinators in all the 6 countries, we are signing up to the Marshall Plan. The International Chamber of Commerce signing in, bilateral countries with bilateral arrangements saying we will appoint you as our implementing partner, we will give you support. African Development Bank, IMF, World Bank, IFC, the 8 European investment banks all signing up and saying, now we'll also support you to bring global investors on the continent so that they set the factories and stop taking raw materials and add value in Africa so that we retain the larger portion of the value in the supply chain in Africa. That leadership outside the bank is simply because of the brand and the reputation we have built. We are believable, we are authentic, and people can trust on us. But Mary, it takes more than trust. An organization can never be better than its governance structures. An organization can never be better than its leaders. The performance of Equity this morning reflects the quality of leaders and governance structures. As the executive director in charge of governance and leadership, what is your take?
Thank you, James, and good morning to all of you. A pleasure to really have this meeting and this discussion. First of all, I would just want to touch on one item. As we have previously said, and I think James talked about this a bit, and my colleagues also talked about this in some detail. Equity is really a creation of the culture that we have set. And that is why every other day we're asking ourselves, are we still living the culture of the organization? And sometimes people ask us, what is this culture all about? And how come it influences the way you do things and the way you perform? But that is just simply because our culture is based on just 2 principles, and that is the value that we attach to people, whether they're internal or external, our customers and other stakeholders, and also our focus on very high productivity and performance. That is always a part of the culture that we have created. So that is one of the items, and I'm glad our group chairman is here. And the board consistently reminds us that the first thing you have to think about, the first thing you have to invest in is the culture of the organization. So, and that will continue. And then, of course, when we talk about the culture, it's internalization of our vision, the reason why we exist as an institution and as a people in the institution, the purpose of the organization is also central to what we do every day. Now, I can talk about governance and also say that one of the realizations that we have seen as an organization is that it is a very solid platform. We set a solid foundation for our institution by observing the best governance practices. So it is our responsibility to always make sure that we understand the reason why we have to do things the way we do, because that is equity. We understand why we have to do that. We understand that, first of all, compliance is very critical, and that is especially very important for us because, as you are aware, there are new issues that we have to tackle today that we did not probably have to tackle a few years before. We are looking at new regulations and new issues affecting our customers, things like data protection issues. They have come up now, and especially the issues that are coming around digital products and services that James has talked about, and my colleagues here. Total focus on that. Actually, if you look at Sam's team now, part of the risk and compliance team, my bet is that in the next year or so, the risk team will be probably just second in size to the tech team and the digitization team because of the central nature of that issue in the business right now. And the reason why we are doing that is also the realization that it is important for us, as we do well today, as James has already taken us through, to really focus on building a very, very sustainable institution. And that is what we are focusing on now. So those efforts will continue. There's another area that has come up, and we are now continuously looking at our strategy on ESG compliance. What are the ESG risks in the first place? Because we also understand now that ESG is the business, and the ESG risks are the business risks. And Sam and team are helping us to also understand this and do what we need to do to be in complete compliance in that area. Let me also talk, James, if you allow me, on the issue of the regional performance and what we are doing there. And James has discussed the numbers in detail. But last year we told you that we had achieved a major significant milestone in the DRC when we finished the acquisition of Equity BCDC. Now, the past year we have focused on completing the integration that came as a result of the merger of the organization. And I'm happy to report that we have done very well there. We have made significant progress, but it is still work in progress. We have started the integration of the business model to the group business model in the DRC after we combined the two institutions. You will recall that one of the banks that we acquired was a corporate business model, and our bank was an SME and retail. So we have combined the two, and we are now just refining the segmentation in that customer base so that we are able to roll out all the products and services that we traditionally offer our customers. And also we are focusing on, of course, rolling out the new innovations that we have been rolling out in the other subsidiaries, including Kenya, and the digitization of products and services. James talked about the issue in Tanzania, also to assure you that we are on top of things in terms of looking at a few issues, the leadership, the business model. We are also aware that the environment has improved significantly post-COVID, and we are looking at what are the opportunities there to be able to turn around that subsidiary. So all focus is there, and I'm also happy to report that the group board has been very, very supportive, led by our chairman here, in terms of looking at what we need to do in that market. Thank you, James.
Thank you very much, Mary. That governance is about to comply with policies, laws, and regulation. And that is one area that we have done very well. This has really been repeatedly tested. I'm sure you have been seeing headlines, Equity and KRA. I'm glad to say the 6 disputes that has been keeping on coming up, we have won 5, only 1 now remaining. And I want to, in a very special way, recognize Lydia Dilango, our head of tax compliance. When you comply, there can be allegations, but the truth will always set you free. We have realized the best thing we could ever do is to comply. However, compliance is not an event, it's not a once-off, it must be the way of doing things. And that's why Mary said governance in equity is part and parcel of our culture. It's our way of life. That is who we are. That's the equity brand. So you can trust us when dealing with us because you are assured that governance failures are not a part of our culture. We hold ourselves to very, very, very high standards. And lastly, culture can only thrive if the environment is enabling, empowering, and appropriate. And you can see how enabling it is that we can have gender parity in a country that struggles to meet 50% or 30% parity. So essentially, it's that total environment. Mary has also confirmed she's in charge of our subsidiaries, and what we thought it would take 5 years has come to happen in 2 years, reducing Kenya to 60% of the business. So now in 5 years, we are confident Kenya will have been reduced to about 40% of the size of the group. I believe that 90% of your questions have been preempted. That's why I gave them a chance to try and answer your questions. But in case there is a question that has not been answered, you see the team. If we always have wondered, who are the executives of equity? The only person missing out there is our group director of communication, Joy Benedicto, who is leading the team to receive the 90 business people from Belgium who we are hosting in DRC. That's really the executive team. So if you have ever wanted a photo of equity executive team, allow me to take a seat, take it, and then we take the questions. So now you know who the executives are. It's not James. Equity is not equal to James. Equity is run by an executive team. This is your chance. This is your opportunity to take a photo as George raises his hat. What you want first of all? To tell very good. I think the photo is there of the executive. Let them be, they claim the credit for the performance. Thank you. We now can take the questions. George has raised the first question. George, welcome.
Yeah, thank you, Dr. Ari. I first of all wanted to commend you for your Wings to Fly program and the way that you've fashioned it to look at these kids as human beings beyond the school and take care of them even at home, as you saw during the COVID period. could be I was late, but would I know from you how much you spent on shared prosperity when you forwent charging customers for transfers of up to 10,000 Kenya shillings? And now that the agency is almost being retired, to what extent has it shrunk transactions via agency? And to the team of Christine, Clement, and another, could it be that digitization of the loan portfolio, taking loans?
Opportunities abound in the Democratic Republic of Congo, DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, Unlocking Trade, Tourism and Investment Opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs, and small and medium enterprises SMEs. The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who are also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back home, and invite you to go and, see what is available for you to do. And you can see this is a very big team. We have farmers here, we have engineers here, we have architects here, we have doctors here. It's a whole team. Just come and look for a niche for yourself, deliver on that, partner with the people on the ground, and you're good to go. It's a very good thing that Equity are involved in this, and I must say congratulations for holding our hands and bringing us. We have a time now to sit back and say these are the opportunities that we had, and this is what we did.
Giving a comprehensive prospectus of opportunities in the DRC, Dr. Mwangi said the trade mission was advised by the need for business decisions to be made guided by facts on the ground.
Today we started the Kenya DRC trade mission. We brought 253 Kenyan entrepreneurs. They are being hosted by over 2,000 Congolese business people. And the objective is to get Kenyan entrepreneurs to see the opportunity in DRC. The second one is to forge partnerships and collaboration with entrepreneurs of DRC so that we promote joint ventures.
Dr. Mwangi put in perspective the economic situation in the DRC, illustrating that the vast country is where Kenya was when only 6% of the population was banked.
DRC, from a financial sector, is where Kenya was in the early 90s. We're talking about 6% of the population being banked, 94% excluded. So this is a market we can grow very rapidly, much faster than we grew in Kenya, where we moved from number 66 to become number 1 largest bank in Kenya.
What Equity has done, I think, is one of a first, because Equity has been able to demystify the whole trade across DRC.
Kenya's Trade Chief Administrative Secretary Lawrence Karanja lauded Equity for partnering with the DRC and Kenyan governments for what he termed as part of a greater vision of the Africa Free Trade Area.
Kenya is keen to enhance trade relations through COMESA, tripartite, and African Free Continental Trade Area. And as I've said, we are pleased to welcome DRC into the East African community, because by so doing, we'll be having a market of more than 200 million people within the East African region. That is a market, and I will be asking the people of DRC and the people of Kenya to look at that opportunity which is coming.
We want more of this because it's bringing like-minded people together. What is also the missing link is normally money. How do you de-risk an opportunity? Working with Equity as a partner, we're able to understand off-takers, we're able to de-risk by making sure that the money is available, we're bringing like-minded people together. Equity is a lubricant in all of this. And by facilitating and going at different government levels, we're removing a lot of wrinkles and allowing us to do business. Just love it.
Day-long discussions in sessions in Kinshasa, Lubumbashi, Goma and Bujimai addressed various topics with strong panels of experts analyzing their respective sectors. An exhibition site was annexed to the plenary where traders from both countries also had an opportunity to showcase their products and services. The delegates had an opportunity to network with their Congolese counterparts in matchmaking sessions and business site visits in all 4 cities. Equity BCDC MD Mukeba was at hand to discuss how the entrepreneurs can partner with the bank.
The DRC is a country of opportunity in the sense that the number of population, we are talking about 100 million people, and it's growing at least 3% per annum. So that shows the headroom in terms of growth, especially when we speak about 6% only the banking penetration. So 94% is the potential of growth.
It is refreshing to see that Africans are going to Africa, and we call them same as we call someone else investor. It is a very good thing. I love the mission.
Participants had a chance to interact and appreciate firsthand the opportunities that exist in trade, manufacturing, agriculture, mining, tourism, IT, among other sectors.
This mission is very good because it is also an opportunity for people of Africa to be together for that good business that we need to do between Africas. Equity Bank is now like a medium, between us in our invest.
Kenya's ambassador to the DRC, George Masafu, expressed his satisfaction with the mission.
Kenyan businessmen are not coming here to do business by themselves. They are coming to partner with Congolese partners here. So the bank is also going to finance the Congolese businessmen, just as they're going to finance the Kenyan businessmen. And we believe that with strong trade ties, the relationships between our two countries are going to be very strong.
Speaking at the Lubumbashi leg of the mission, Deputy Governor of Katanga, Jean-Claude Kamfwa, thanked Equity BCDC for the initiative to bring the Kenyans.
Je tiens donc à saluer l'implication du groupe Equity Bank et Equity BCDC dans l'organisation de cette rencontre qui, reconnaissons-le, revêt toute son importance comme étape cruciale devant permettre l'éclosion d'initiatives régionales, favoriser les synergies et la création de valeur pour nos deux pays et pour notre belle province.
Everything in Congo is an opportunity, if I have to say so. Everything is an opportunity. There's no field in this country you can tap in and not get successful. Everything, no matter what you think about. Because just take the population, 100 million. Who don't want a market of 100 million customers? It's ready available. You think of agriculture, you think of education, you think of medicine, you think of all the fields are in need in DRC.
Equity Group Chief Commercial Officer Polycarp Igade said the mission has opened doors for Congolese entrepreneurs to visit Kenya.
We come to seek partnership. We come to embrace you, to give you a normal African hug, and to shake hands as equal partners. So we expect that there'll be a lot of business from DRC coming to Kenya and a lot of Kenyan business coming to DRC.
At the opening ceremony of the Goma conference, the governor of North Kivu, General Constant Kongbanima, said the DRC government is setting up economic zones to attract foreign direct investments.
Et vous souhaitez la bienvenue à l'occasion de la cérémonie d'ouverture de la mission commerciale Kenya République démocratique du Congo 2021. En effet, cette mission organisée conjointement par la République sœur du Kenya et de la nôtre, regroupant plusieurs hommes d'affaires, tant kenyans que congolais, a pour mission la promotion et la consolidation des relations commerciales et économiques entre nos deux États. A conduit cette mission et aux hommes d'affaires kenyans pour le choix judiciaire de la République démocratique du Congo comme destination de prédilection pour les affaires en général et en particulier la province du Nord Kivu.
Equity Group CEO Dr. Mwangi said the bank has set aside $5 billion for entrepreneurs to invest in farming, tourism, manufacturing, logistics, among other sectors.
There would be no better force of changing Africa than the business community. The business community, all entrepreneurs, organizes resources, takes the risks, and create products and services for the consumers, and in the process, they create wealth. The real cure to African challenge is wealth.
Citing Serena Hotel, Goma, as an example of cross-border investments, Dr. Mwangi said Goma and the surrounding region has a huge tourism investment potential.
Hasten your steps and invest in DRC. The tourism opportunity here is big. I was envious last night to see the hospitality in the lake. It's only by collaboration and partnerships that we can progress and take the continent to the next level.
East and Central Africa region has a long history of trade that has continued to the present. Indeed, the DRC is the 6th largest market of Kenyan goods.
Beyond having an embassy, we have now brought in a commercial attaché to confirm the importance of this region, Goma region. From the month of October, we started direct flights from Nairobi to Goma. When we started, we were doing 2 flights a week. Right now, we are doing 3. And we are looking forward to having daily flights.
Although the Eastern DRC has been the subject of news on insecurity, the delegates learned that intensity of conflict is low. In Bujimai, the governor of Kasai Oriental, Janet Muswamba, said Equity BCDC is an asset. She said the province has the longest section of the mighty Congo River and there are opportunities for investments in agriculture, mining, tourism, water and energy utilities.
Je voudrais également saluer les membres du gouvernement provincial et plus particulièrement celle des opérateurs économiques de ma province, dont la présence traduit tout l'intérêt qu'ils attachent à l'ouverture au monde, à travers les échanges commerciaux pour des conditions de vie meilleures dans notre espace commun.
The partnership between Kenya on the eastern seaboard of the Indian Ocean and the DRC on the Atlantic Ocean has opened age-old trade routes. For the delegates who participated in the trade mission, the initiative was an eye-opener that will herald a new beginning for Eastern and Central Africa.
Mkutano unakuwa nzuri kwangu kwa sababu ninakutana na entrepreneur wa kutoka Kenya na ninajua kama tutafanya partenaria, ile tunaita partenaria, kwa sababu niko frame international, najua kama nitakuwa international kabisa kwa sababu pamoja na entrepreneur kutoka Kenya tutaungana pamoja na tutaendelesha uchumi wetu kwenye Kongo pia na kwenye Nairobi.
I would like to add the Kenyan population, the people who can do business here in Congo. There are a lot of opportunities here. Please come and let's move together. Let's exploit these opportunities so that we can move forward as a community in Kenya.
A big appreciation to the government of DRC and to the government of Kenya. First, bringing 250 companies from Kenya to come and see the opportunities here. And Equity BCDC being able to show us the way, telling us we've been here before 7 years, this is how we've been able to prosper, this is how we've been able to transform lives in this economy, and telling us, come, we want to do business with you. That is not something to be taken lightly, getting all of us here.
This was a very good call for both countries. And especially I thank Equity for facilitating this, because for many participants I've been able to talk to, is an eye opener for them.